All right, welcome everyone. Good morning. We'll throw the chat up there. You could drop some comments in the chat as you tune in, and we'll wait just a few minutes to get started, like always. Hope everybody had a great week. Happy Friday, everyone. All right, Amanda, good morning. If you're just tuning in, go ahead and drop a comment there in the chat. All right, good morning, everyone. Got a great topic here for today that we'll get into in just a second. Just need to wait to go live on all the different platforms.
Yes, Taryn, we are mind readers. We were thinking about your deal here when we were thinking of the DPA.
All right, good morning, everyone. Dropping comments in the chat. We'll get started in just a second here. Good morning, good morning. All right, looks like we are good to go. We can go ahead and get started here. We'll go ahead and take the chat off the screen, and we will get into it. So, welcome everyone. My name is Kyle Hiersche. I'm the COO of the Mortgage Calculator, joined here by Nick Hiersche, our president, and our sales manager, Jose Gonzalez. We are a correspondent lender that specializes in non-QM loans. And although we specialize in non-QM, we still do plenty of conventional FHA, VA, and USDA loans. So we still do everything here. And today we're going to be discussing down payment assistance programs. So Jose is going to do a deep dive into this topic here in a little bit. But before we do that, we're going to do what we do every morning, which is pull up our pricing tool and go over the rates for today so we can see what the market is doing here today. So Nick, why don't we go ahead and pull up the tool? And it is April 7th, just after 11 a.m. Eastern time. So the rates are live. So let's check them out.
I would caution that the rates aren't all live. It is Good Friday, so some of the rates are not reissued today. So these may be some from yesterday. But let me go ahead and switch my screens, and we'll get into the pricing tool. All right, so this is our pricing tool. Let me switch the view here. There we go. This is a pricing tool for our team of mortgage professionals. We have over 300 loan officers licensed in 22 different states for primary and second homes, and we can do our DSCR business purpose loans in about 45 states, I believe. So a lot of great options there. If you'd like a full breakdown, please get with one of our team members. They can get you a full loan estimate with all the details. We're going to use our quick pricing tool today to check out our general pricing and APR for our general programs. Since it is kind of a weird day, right, with the markets, some of the programs do have live rates today, and some are closed today for a Good Friday. But we'll still be able to compare across the programs. So first thing we're going to do is set up our general scenario. We're going to keep a $400,000 loan amount, pretty average there. We're going to set the LTV to 80% loan, 20% down payment. We're going to set the desired price at 99. That means we're going to ask the computer to find the best rate combo for one discount point in cost. Typically, our customers are asking to buy down the rate a little bit on all of our requests. So that is the typical request that we're getting. And we're going to compare our programs. First will be conforming conventional. Then we'll do our FHA programs, which will also be what Jose will be discussing in detail on the DPA is typically a FHA program. And then we'll go into our expanded guidelines, aka non-QM. That's where we have over 5,000 additional loan programs beyond your standard that allow us to use alternative income. We can quote VA. That's only for our eligible vets. So if you are eligible, please get with our team. We'd be happy to quote it. But since not everybody is eligible, we don't do that live. And same with USDA. That's only for properties in a rural eligible area, USDA eligible area. If you do happen to be shopping there, let us know. but not everybody is, so we don't do that live either. So we'll first start with our conforming conventional. For all of our scenarios, we'll do a purchase, 30-year fixed standard loan, primary occupancy for these first few examples, single family home, 1 unit, state of Florida, county Miami-Dade, because that's where our office is. And for all of our demos today, we'll use an estimated FICO score of 760 and an estimated debt to income ratio of 40. So let's check out our rates this morning. Pretty similar to what it's been over the last few days here. We love to see when the rates are lower. So here we have a great option. Looks like the best option that computer found, 6.375 rate for 1 discount point in cost and a final APR of 6.551. So remember, we use the APR to compare across programs. That puts all the costs of borrowing into the rate there. So that's what we use to compare. So right now we have conventional 6.551, little bit higher than it was earlier this week, but a lot lower than it's been for the last 6 months. So great options now for our borrowers to lock in their deals. Now, if there's any reason the borrower doesn't qualify for conventional, typically the next option, we'll set up the same scenario, is going to be an FHA program. So we'll set up the same scenario, switch it to FHA, keep everything else the same, and now we'll be able to compare FHA to our conventional. So obviously much lower rates for FHA. Right here, the computer found, looks like the best combo is actually the second one down, this 5.625 rate for 0.75 discount points in cost for a final APR of 6.218. Remember, FHA has a upfront mortgage insurance and a yearly mortgage insurance that you pay monthly. So always compare the APR, because even though the rates are lower, the APR is usually a little bit higher. But in this case, even though the APR is a little higher, 6.218 is a little bit lower than the conventional. So apples to apples across programs right now for this exact scenario, FHA is a little bit cheaper. So definitely recommend our borrowers out there shopping. Don't discount FHA. Those changes recently that lowered the costs, obviously, you can see it here. The APR is slightly lower for the exact same loan. So definitely compare those programs. FHA, lot of action lately. Now we'll go back to our pricer. And for our final primary home demo, if a customer doesn't qualify using conforming or FHA guidelines, remember FHA allows us a little bit higher DTI, a little bit more relaxed guidelines in general, but many times our borrowers need a little bit of extra help. So that's where other banks and lenders often do not have other programs, but thankfully here at the Mortgage Calculator, we specialize in non-QM. So we can click under expanded guidelines and we have over 5,000 additional loan programs that pop up for our borrowers. So we'll set expanded guidelines, everything else will stay the same, but we have one new option here for income verification. So under expanded guidelines, aka non-QM, we can do full doc, which is 2 years of tax returns. That's what conforming and FHA use. Typically, the reason we would choose a non-QM program, an expanded guidelines program, is to use alternative income. So that's where these other options come in. 1 year alt doc, 2 year alt doc. We can use assets without even employment. We can use business bank statements for our investment properties. We can do DSCR. We'll do that in a minute. And our most popular program by far is going to be our personal bank statement 12-month program. And that's going to be for our self-employed borrowers. Many times our self-employed borrowers, when they have 2 years of tax returns, have various write-offs and have a hard time sometimes qualifying, but they actually make a decent amount of money. So in this case, we'll be able to use their actual cash situation, the actual cash in the bank from 12 bank statements to determine their debt to income ratio using those cash bank statements rather than the 2 years of tax returns. So typically a customer who would not qualify at all can now qualify, or a customer that needed to qualify for more loan, a higher income amount for a higher loan amount can now qualify. So these programs are problem-solving programs. So we love to compare these. If our customers are on the edge of the conventional qualifications, we can very easily still get them in the home with these non-QM programs. So let's check out these rates this morning. Remember, non-QM is going to be a little bit more expensive, but again, this would be for a borrower who would otherwise not be able to get this home. So great options to solve problems. Right here today, we have a 7.25 rate for 0.75 discount points in cost and a final APR of 7.289. So great option for our borrower there. Remember, our conventional was at 6.55, I believe was our APR. So not even a whole point higher than conventional. Great option, again, for a borrower who would not otherwise qualify. Just a little bit higher. We love when our non-QM is very comparable. definitely recommend to any borrowers out there that are shopping, look at these options. They do afford a lot of flexibility, not only in calculating income, but if you scroll down here, there's tons of different options. Some of these may allow things like a recent credit event, such as a foreclosure or a bankruptcy. So when we get into these non-QM programs, there's tons of different options. And as you can see, there's hundreds of different programs just under this one option. So please get with our team. We'd be happy to find which one fits best for your scenario and solve problems. That's what we're all about. Now for our final couple demos, let's go back to the pricer. Every day we want to not only do a primary home pricing example, but we always want to check out our investment property rates. We love to work with investors, whether you're a first-time investor getting your first property or you're a seasoned investor with 5, 10, 100 properties. We have options. So very quickly, we'll set up the same scenario, 80% loan, 20% down payment for an investment property. And we'll compare our conforming conventional with our expanded guidelines non-QM. Remember, FHA, VA, USDA, not eligible for investment properties. So we'll set this to conforming. Everything else will stay the same as all our other examples. All we did was switch it to investment property. So let's check out the difference here on the conventional investments. So great option popped up here at the top. Obviously, this is the lowest APR, 6.75 rate. But you see here, very high discount points. The GSEs have added loan level price adjustments, which make it hard for our computer to find an option with one discount point. This option has 3.25 discount points, which is quite a bit of money out of pocket. Final APR of 7.001, so great APR. We love to see that. However, many times our investors don't mind going higher in rate in order to reduce this cost out of pocket, these discount points. So under conventional, we are kind of stuck here because of these recent changes where we just really, even if we go up in rate, don't have that many options for lower discount points. Here's a decent option here, 7.5 rate for 2.25 discount points. But many times our investor would like to deploy their money on other investments rather than discount points. That's where we love to offer not only our conventional programs, but our non-QM investment property programs. A lot of flexibility and hundreds of programs here. So for our final demo, switch back to investment, 80% loan to value, and we will do expanded guidelines non-QM. Now, under expanded guidelines, our most popular program for income verification is going to be our DSCR program. And that's because it actually doesn't require any income verification. We're simply going to use the estimated rental income from the property to cover the mortgage expenses, the PITIA of the loan we're doing right now, as long as the estimated rental income will cover the mortgage expenses, the PITIA. That's a ratio over 1, and we have hundreds of loan programs for DSCR ratios over 1. We even have programs for ratios under 1, so a property that doesn't quite cash flow. So tons of options here under this DSCR program umbrella. And for our non-QM investment properties, we typically always have a prepayment penalty. The standard is 3 years, so that's what we'll do for our demo. We do have options for 0 prepayment that will cost more and limit our loan programs. And we also have options for a 5-year prepayment to save some money, but that does limit our loan programs. They don't all have a 5-year option. So the most common is 3 years. That's what we always use for our demo today. And let's check out our DSCR rates this morning. So some good options here. Again, we love it when our rates are in the 7s. So the DSCR rates have come down this week. We love this. So the best option the computer found, 7.625 rate for 0.975 discount points and cost, and a final APR of 7.671. So great options here for our DSCR. As you'll notice, there are tons of different versions with different DSCR ratios, different prepayment amounts, and just hundreds of different options here under DSCR. Some of these may allow things, you might see a higher rate, which might not make sense at first, but you might realize that these might allow things like short-term rental income, like AirDNA, and other exceptions. So tons of different options we have here. We even have options for DSCR programs for 5 to 8 units and mixed use. Lots of different flavors of this program. So that is the final demo for today. Let me go ahead and switch my screen and we'll introduce our topic. So we're going from DSCR. Now we're going to go back to primary homes. So let's put on our primary home hat and give me 1 second. Let me switch my screen. And today's topic, if you caught us earlier, is going to be on our down payment assistance program. So this is about as primary as you can get. This is obviously only eligible for primary homes, only eligible for certain borrowers that qualify. Down payment assistance is very tricky. It's a popular topic. I'm sure Jose is going to quickly dispel some misconceptions here on the programs. As I mentioned earlier, these are programs that apply typically to FHA loans. So what you saw there on the FHA is going to be kind of the category we're within, but a lot of different caveats that come with down payment assistance. We love to offer them, but there is definitely some caveats there. So loan officers, pay attention here. And for those customers out there that might be interested, hopefully this is helpful for you. So Jose, if you're ready, let's go ahead and have you take over.
Good morning, everybody. Jose Gonzalez, sales manager here. Thank you for joining us for Daily Rates Live with the Mortgage Calculator. Down payment assistance, very good programs, but often misunderstood, right? A lot of times we think that down payment assistance programs are only for first-time home buyers. So we leave money on the table there with our non-first-time home buyers that would qualify. The misconception is that most borrowers and a lot of MLOs assume that down payment assistance programs are those programs that are only those programs that we hear about that offer assistance from municipalities or states or counties, right? Those quote unquote bond programs where you have to apply for the program, you have to take educational courses, it takes time, they approve you after you complete the courses, and after they vet that you have like no money, and then they put you in line and you wait until funding is available for the program. And when your funding window is open, then you have to rush, try to find a property, and then be aware that those programs do take longer than a regular FHA loan, because after the lender approves you for the first mortgage, then that package has to be approved for the assistance as well. And we know that sometimes the municipalities and counties and state organizations can take a little longer than the regular banks, lenders, loan officers, brokers, and so forth. So be aware that what we are going to discuss now is not that program that everybody assumes is the only option. Those options are very restrictive. To participate as a lender in those options, you have to be nationally registered for all of those options, something that isn't basically logistically possible in a lot of in a lot of instances if you're a national company to be able to abide by all of the individual requirements of all of those programs that do require strict adherence to their guidelines, to their compensation guidelines. It is a logistical nightmare, and frankly, very few borrowers actually qualify for any of those programs. And then once you do have them running around with their pre-approval, they need to find contracts that'll accept closing in a longer than standard time. You know, typically when you're out there competing for contracts, trying to land the deal, it becomes a little bit more difficult when you put forth the pre-approval and it is for an FHA loan tied to one of these assistance programs, and then you're going to have like a 60-day closing, for example, as opposed to a 30-day closing on the contract. So keep those expectations in mind, and if you do consider using any of those programs, make sure that you communicate very clearly to the buyer's agent to prepare them for how they have to present the offers. So it's really important stuff. Now, the programs that we're going over here are not restricted to first-time home buyers. They are for any buyer that is buying a home, right? Strictly, they just have to adhere to the guidelines of whatever is the program. In this case, we're talking about an FHA 3.5% regular FHA program, no first-time home buyer requirements, because another misconception is that you have to be a first-time home buyer to get an FHA loan, and that is absolutely not true. The only requirement really that could be considered something similar to that is that an FHA loan is for a primary home, right? Primary home only. That's the main point. No investment properties, no second home, primary home, but it doesn't mean you have to be a first-time home buyer. What is a first-time home buyer? It is a buyer who or borrower who does not currently own a property, obviously, and has not owned a property in the last 3 years. That's why in the loan application, in the declarations on page 4, one of the declaration questions is, have you owned the property in the last 3 years? Yes or no. So obviously, if you mark yes, the system already knows you're not a first-time home buyer. If you mark no, then the system knows that you're a first-time home buyer because you have not owned a home in the last 3 years. So now down payment assistance has many forms as well. You have forgivable option and repayable option. The forgivable option is going to have a higher rate associated with the first mortgage. Obviously, it's a higher cost because they're building in some of that forgivable aspect into the cost of the loan. You're going to find a lot of that goes on with the DPA, right? Down payment assistance programs. But the forgivable option, if the borrower has not made any, is currently not, 90 days, not late, and has not made any 90-day or more late payments on the loan. So you got to be current on the loan and no 90-day lates in the first 5 years of the loan. After 60 payments are made, if you meet those parameters, the loan is forgiven. Obviously, you have to also still be living in the home because these loans are not geared towards investment. So if during those first 5 years in the property, you move out of the property, then that you're going to have to repay that loan because you're supposed to stay in the property for at least the first 5 years. And obviously, if you refinance the property, that loan is also going to be refinanced with the first because it is tied in to that first. It's a package deal. The repayable option does not have the restriction, but it's repayable. The difference is going to come at a little bit lower rate on the first. It has a better cost because you are repaying the loan. And then we have a closing cost assistance option. You say, how would that be different? Isn't that the same as down payment assistance? Well, I guess it is, but they just call it something different because it has a different rate associated with the first mortgage as well. We have a 3% closing cost assistance of the purchase price, 4% closing cost assistance, and 5% closing cost assistance. All have different interest rates on the first mortgage. Those 3 options are all repayable options. And in all cases, the repayable options are a balloon mortgage, 30-year amortization, 10-year balloon. That means after 10 years, it's due and payable. So typically, you have to refinance or sell the home or just pull out the money and pay what you owe. But it's a 9.99% interest rate on that. So that's the same program for all of the DPA. And when it's forgivable, you're not making any payments on that either. So in our first example here, so now I'm sure you're wondering, okay, Jose, but what?
Let's run this back to one more time. So we're talking about national DPA programs. These apply in all states. These are not the local programs that he was mentioning earlier, which are very restrictive, both in qualifications and location and all of that stuff. So 2 different types of DPA you're talking about, local versus national, correct?
Right, correct. And one other very important point to consider in your DPA is that the down payment assistance program that we're talking about here, the one that we're presenting, we really feel is the best one, the best combination out there. And listen closely, people, because this one has lender paid pricing and not borrower paid pricing. You have to be very aware. That makes a very big difference. What does that mean? Okay, when for those of you not in the industry or those of you new to the industry, lender paid means that the compensation is built into the interest rate. Borrower paid means the compensation is not built into the interest rate and needs to come from the borrower. That's why they call it borrower paid. So that means that if there's no compensation coming from the rate on that product, that means that the borrower, and this is the irony of the situation, is going to do a DPA program that is going to have a higher cost associated with it out of pocket than if they did non-DPA. So what is the benefit there when the DPA amount could almost be equal to the amount, the additional expense that they're going to incur, right? There's a very limited benefit there, maybe 1% benefit there, 1.25% benefit there, if any, versus non-DPA. No, actually the benefit would be a little bit less. It would be like 0.75% benefit. So you're not really looking at any real benefit, because that requires then you to structure the deal, or the realtor to structure the deal with seller contribution. So yes, if you're in a market where inventory is so readily available that sellers are loosening their grip on the deal and giving seller contribution, then great, that will work. But if you're in a market that's super tight and now you're putting forth an offer, you're competing with 3 or 4 other properties, and all of a sudden your offer comes in with pre-approved for DPA and a 3% or 4% seller contribution, that's going to be a tough deal to get accepted versus the DPA coming in, which is a program we're going to propose now with no seller contribution requirement. That's a true benefit DPA. That's benefiting the borrower 100% versus the other one, which I think is more of a shifting the liability to a seller. And for that matter, realistically speaking, you'd be better off not doing a DPA, negotiating seller contribution of 3, 4, 5% of the sales price, and getting a better rate and getting the seller contribution and getting the same benefit. And this is something, Nick, that we go over this scenario all the time when we're showing non-DPA pricing and DPA pricing, and the end result is that it's a higher rate for the borrower when they're going the regular borrower pay DPA. The option we have here is lender paid DPA. There may be a little bit of a pricing hit, but it's typically lender paid.
So these are not the local. We're only going to present nothing local and just the national, and just the lender paid one that he's talking about that actually provides a benefit. So there's thousands of different options here, guys. Jose's going to probably present 5, but remember, these are national. These are going to be lender paid. So these are going to actually provide a benefit. So let's go ahead and pop these up then.
All right. So now this would be obviously the most popular one, right? Forgivable, which means, like I stated, it's forgiven after 5 years, no 90-day lates, and you're currently not late after.
Can you zoom in a touch? We can't read the text there.
Let me make it a little bit bigger. Sorry about that.
There we go. Now we can read it.
Okay. So if after 5 years, no 90-day lates on payment 61, it's forgiven. That's it. So, you pay it for 5 years, and then whatever balance is left over. So you do your amortization schedule and see what the real benefit is of the forgivable versus the repayable, because you do got to make payments for 5 years. But nevertheless, look at this, 7.625% rate and only $594 in points in loan discount, right? So again, fully lender paid. This is our scenario here, right? I mean, assuming obviously you're in an area that has a $482,500 FHA loan. So this is our forgivable option. Now let me show you the repayable option, just so you could see the difference in the rate, right? And the cost. So here, 7.125% rate with only $260 in points. Basically a par rate. I think it was like 0.005 or something like that. $260 in points. That's nothing for 7.125 versus 7.625. So now you see that the difference between the repayable and the forgivable is 0.5% in the interest rate. So you really got to consider the long-term objective of the borrower in that loan. Are they going to stay in that loan beyond 5 years or not? And figure out your amortization schedule and see what is the true benefit of the lower rate on a long-term basis versus the higher rate and the forgivable nature of the loan. Because after 5 years, you're going to have made some payments, right? So it's not like you're getting the full 3.5% for free. Just whatever is left after 5 years gets forgiven. Do your amortization table, see where you are on payment 61, and that's the amount that gets forgiven. So now we're going to throw the twist here, and we're going to go in the closing cost assistance option. All of these have the same final second mortgage at the same rate and everything. The only difference here is what is the percentage of assistance that they're going to give you. So this one gives 3% closing cost assistance. So total assistance on this one is $15,000, right? And now look at the rate. This is why you would choose this option over the repayable option. It's a little bit less benefit. This one is 3%. The repayable is 3.5%. But then look at the rate here, 6.75%. And look at the lender credit. So now we're seeing better pricing. This is still a DPA program. They just call it closing cost assistance. They got to, package it, market it some way to differentiate their product mix, right? To not confuse us, the loan originators and the borrowers. But basically the difference is the rate and the cost on the rate. So you get $15,000 here, folks. This is going to pay for the closing costs of anybody here, and $1,041 lender credit to boot, and fully lender paid. Now this, to me, amazing option, but there's more. Look at this one now. You got 4% with a total assistance of $20,000. In this example, I tried to keep it the same rate, just so you could see the difference in the cost, because there is a higher rate available without points, but I wanted you to see what it would be between one and the other. So if this one 6.75 was costing $1,400 versus the other one giving you $1,000, so you're at about a $2,400 swing, which is about 0.5 point difference. So keep in mind where you're at. You got 1% more assistance, but it's costing you $2,400 more. So the real added benefit for this program is only 0.5% more. So these are the kind of analysis you got to do for your borrowers, or obviously just get the higher rate, right? And then we have the 5%. Now this is pretty cool. 5% of the purchase price closing cost assistance right here. But look at the cost at 6.75. It's prohibitive, $4,482. That's a full point. So you're not getting the benefit there. So just to show you now what are the options on this one at the highest rate possible that provides a benefit, would be 7.25% rate, still a little bit higher, 16.35. But now here we do have the benefit. If the borrower says, Jose, no, I need that dough, or else I'm not going to close, and I want to do a few repairs to the house after I close, so I need a little money. I don't want to use my credit card because I need some tax deductible expenses. Boom, this is a great option here. Don't use up those credit cards to buy, new furniture, refrigerator, whatever. Put it into the home. You got your tax deductions, 7.25%. It's still going to get you $25,000. That's 7.25%. So again, most of you may not have known that these options existed. 5%, 4%, 3%. You always got to combine them with the FHA loan. Very, very good options here. No first-time home buyer requirements. Oh, and I forgot to mention, real important too, no income requirements either. You don't have to meet any HUD, median income, 80%, 100%, none of that. This is just pure FICO score, FHA requirements, and do you need extra money? So great options out there to help people who need a little bit of assistance. No restrictions here, and great pricing.
Sweet. So we got some questions here. I was expecting even more, but there's a couple here. First, there's one not related to DPA. I guess we'll do this one real quick. For bank statement loans, Jose, you want to take this one?
Yes, the answer is yes. If you have two borrowers who have different income types, you have to determine who's the main borrower, who's the one with more assets and more money, because it would have to be our bank statement borrower. So as long as our main borrower is the bank statement borrower, you could have co-borrowers that are W-2. We also have options where we can actually mix and match every single income type that we have under one loan for the borrower. So that borrower can be bank statement, that borrower can be asset depletion, the borrower can be P&L, depends how many businesses they have and how they want to treat each business. We can actually mix and match within the same loan for the borrower. So that is really cool.
And we had a question here. Can we do this loan in NY? No, we're licensed in 22 states. We're not licensed in NY, so we wouldn't be able to do this in New York. But you can check out the list of our states, 22 total. And the next one here from Taryn regarding lates. This is still a DU loan, right, Jose?
Right. Well, now what we're talking about when I was mentioning no 90-day late was regarding the forgivability of the second mortgage. If you have no 90-day lates on that payment, is how they're referring. It has nothing to do with the underwriting of the loan to close. In that respect, yeah, we're still going with automated underwriting. There are minimum credit score requirements here for 660 for the 660 for the repayable, 620 for the forgivable.
All right, Dorian asking, obviously for the DPA, does the minimal required investment of 3.5? Well, it could be from a gift, and this is a gift, right?
Yeah,
so
absolutely.
You code DPA where you put gifts, but you put it's a government. There's like 3 different categories. There's the local one, which is a different category than the national one. So it's just a matter of where you mark that gift, but it's essentially coded as a gift on page 4. If you're doing the actual 1003 there. But we'll get into that on more of the loan officer training stuff, right, Jose?
Yeah.
But to be clear, there is no contribution required from the borrower on any FHA, correct?
Correct. I mean, there's a 3.5% down payment, but that can come from different sources, not necessarily from the borrower.
Exactly. All right. And okay. Angela asking, does closing cost assistance DPA cover the down payment and the closing costs, or just closing costs? Great question.
Yeah, I think we sort of just covered that one in the answer that we were talking about. Yes, if there's an overage of the monies, right, then it could definitely go to cover the sum of the down payment as gifts, like Nick just mentioned.
But remember, the seller contributions can't count as down payment. So I think that's where you're kind of confused there, because it is true, right? A seller contribution could go towards costs, but not down payment.
Correct.
Oh, this is a good question. Mix and match. Can you mix and match DPA, Jose?
No, it's, one or the other, so just figure out which is the one most advantageous to the borrower.
For those just listening, the question is, can a borrower get the closing cost assistance and the DPA in one deal? That was the question.
Yeah, no double dipping.
Yes. That would be very nice, right? And then asking, if closing costs come in lower, can we use the extra funds to buy the rate down? That would be if it's on the right side of the equation there, right? Because you can't use certain funds to buy certain things down, but yes.
I mean, essentially, the closing cost, the buy down of the rate are closing costs. They're all
Exactly.
tied in together. It's not like one is going to be independent of the other. You're going to do your assessment of the closing cost based on a certain rate, itemize everything, reconcile at the bottom. And if you got any money left over, then you just keep buying down the rate as much as it makes sense to the borrower until you reach the limit of what they can know. There's no money left over unless they want to apply that as gift to go towards the down payment. Either or, they can decide, and you would assist them to see which is going to be more of a benefit to their monthly payment. Sometimes it's more of a benefit to buy down the rate because it doesn't cost that much to buy it down, let's say 1/4% or 3/4% of the rate. And sometimes it doesn't make that much of a difference, but $1,000 or $1,500 loan amount may make more of a difference. So it is specific to the pricing on each deal that you're doing.
All right. And Dan's asking where you can find these. Well, we have a ton of outlets. If you're on our team, Dan, just check our resources. If you're a borrower out there looking for these programs, we'll go ahead and have Kyle wrap it up then and give our contact info. So
Yeah,
why don't you go ahead and wrap it up, Kyle?
Yeah, absolutely. You can connect with one of our loan officers at themortgagecalculator.com, or you can send us an email, info@themortgagecalculator.com. We have over 300 loan officers. We are licensed in 22 states, which is where we would be able to do these DPA programs, right? These are for primary residences only. However, we also work with investors a lot. That's what we specialize in, is non-QM. And a lot of the business purpose loans, which is our favorite loan, a DSCR loan, we can do in almost every state. So if you want to connect with one of our loan officers, go ahead and go to themortgagecalculator.com. As you can see, as Jose went through this, it is not just clear cut dry. It is not that simple. This requires a consultant to walk you through the different steps and evaluate the different benefits to the borrower. So definitely connect with one of our loan officer consultants, themortgagecalculator.com, or email us info@themortgagecalculator.com. Now, we do this show every single weekday at 11 a.m. Eastern, where we go through the live rates so we can see how those fluctuate. And then we do a deep dive into a different topic, just like we did today with the down payment assistance program. So definitely tune in every weekday while we go through those. Thank you, Nick. Thank you, Jose. Thank you, everyone, for tuning in and asking the questions. That was great. And we hope to see everyone on Monday at 11 a.m. Eastern.
Thank you,
everybody. Take care.
Thanks all.